Hey everyone! As I've mentioned in previous videos, the perception of the commercial real estate investment market varies substantially between institutional investors and private investors. I think one of the factors driving this difference is tied to the risk tolerance of the two investor types. In general, a majority of the institutions are still on the sidelines waiting for another shoe to drop. Many of them believe a wave of distress is still coming and that prices will fall by another 5% or more before the market stabilizes. On the other hand, the private investors I talk to believe the market may have bottomed already, or it's at least close enough for deals to make sense. Of course, whether the market's at the bottom already will depend on the specific property type, its location, etc. In addition, a lot of the larger private investors are trying to put deals under contract before the institutions fully re-engage. They prefer not to compete with the deeper institutional pockets. So private investors are testing the market while many institutions remain more cautious, potentially awaiting distress. But as I've shared in the past, aside from office properties, distress remains low. The CMBS delinquency rate for commercial real estate as a whole is just 5.1%, about half the levels seen in the financial crisis and during the pandemic. Looking at specific property types, the industrial CMBS delinquency rate is just 0.4%, while apartment delinquencies are a still low 1.3%. Retail CMBS delinquency rates have been trending lower, now standing at 5.9%, and hotel delinquencies have been relatively stable around 6%. Of course, the one property type showing a pronounced upward trend is office, which now has a delinquency rate of 7.4%. But we are starting to see a little more distressed asset pressure, and more sellers are coming to terms with current pricing standards. What I mean by that is we're seeing more sellers price assets to fully engage the market rather than holding out for premium pricing. As one investor put it, more sellers are coming to terms with reality. And a big part of that is how banks are handling maturing loans. As I've mentioned in the past, last year the FDIC and the Fed supported giving banks the flexibility to extend performing loans, and banks were doing that. But from what I've been hearing, more and more banks are tightening up on this practice. More lenders are playing hardball. And one of the reasons, I understand, is that bank regulators are becoming increasingly assertive about clearing maturing debt off the bank balance sheets. As a result, more commercial real estate owners will need to either refinance their properties at the current rates and debt service coverage ratios, potentially requiring investors to inject significant additional capital, or the investors will need to sell the properties. Last year, approximately $300 billion of commercial real estate debt was extended, but by the sound of things, the window of extensions is starting to narrow. In addition to the delinquency rates published by TREP, I also monitor CRE IQ. They show what they call distress levels, which are much higher because in addition to the delinquencies counted by TREP, they include at-risk debt like any loans in special servicing and any loans that have matured but haven't been paid off. I believe that includes extended loans. So the CRE IQ distress numbers are much higher. Finally, I also monitor the MSCI Distress Tracker, which includes more than just CMBS loans and also it uses a broader definition of distress similar to CRE IQ. MSCI indicates that there's about $88 billion of current outstanding distress and another $205 billion of potential distress. The combined MSCI total of $293 billion would constitute about 6.5% of the $4.5 trillion of total commercial real estate debt. Again, that's elevated, but not anywhere near what we saw during the financial crisis. So there is some distress out there, but it's not severe. According to MSCI, distressed sales made up just 3.9% of the total sales dollar volume in the first quarter. So once again, I want to suggest that the commercial real estate distress levels are more of a ripple than a wave. and most of the commercial real estate pricing recalibration has already taken place. There may be a bit more to go, but timing the exact bottom of the market is always exceptionally difficult. You usually only know you hit the bottom after the fact, when you're looking in the rearview mirror. And by then, it's too late to do anything with the information. So instead of trying to time the market and spending your time watching the rearview mirror, I want to remind investors to look forward and to keep your eyes on the horizon.